Hey, Archie, the market's been getting banged up a little bit lately, and I'm itching to get out.
Well, Rob, let's not make any rash decisions. I'm Archie Hoxton.
And I'm Rob Hoxton.
And this is Last Paycheck, weekly wisdom to help you retire and stay that way. Welcome back to the Last Paycheck Podcast, brought to you by Hoxton Planning and Management. We're your hosts, CFP professionals, Archie Hoxton and Rob Hoxton. And today we're going to talk about something that is on all of our minds right now at the time of recording, and that is market volatility. It's been pretty volatile out there, and we thought it'd be a good time to talk about what may be causing that, what you should think about doing, and what you should probably avoid doing.
I love it. Archie, we get a lot of our ideas about episodes from our clients, right? And so, and we know because we're talking to our clients as we do all the time, that people are nervous.
Yeah.
There's a lot of uncertainty that's happening right now coming out of Washington, all of the geopolitical stuff that's going on around the world. And then now the market's gotten kind of, at least the stock market has been sort of taking a couple of hits along the way here. So it seems like a good time to talk about this, remind folks of, what they ought to be thinking about.
Yeah. And we get stuff like this often, I think, more frequently than people realize. I mean, we get corrections in the stock market, which is a loss of about 10%, depending on what index you're looking at. We get those much more often than people think, and often you just sort of
usually about
right
once a year, intra year. It doesn't mean that the year's a negative year. In fact, oftentimes it's a positive year. But throughout the year, at some point, there was a drawback and a drawdown in stocks.
Right.
We forget about it, but during the heat of it, it's kind of stressful.
Right. It is, and although sometimes it happens, and you don't, if there's not some other big related news that's sort of being tied together with it, you can also kind of just like sleep right through it sort of thing and just miss it. And then we get bigger market events a little less frequently than that, like a bear market where the stock market's down, 20% or more. That tends to be a little bit less frequent, typically every 3 to 5 years historically, on average, and that's not necessarily it's not on the dot, it's not like it's planned, but that's in history. That's roughly the amount of time between those events.
Let's talk about what's happening right now, and let's start with sort of a macroeconomic perspective. So, sort of the high level, the view from 30,000 feet. There are a few things that are happening that are causing uncertainty for the markets, causing some stress, and certainly volatility. One is what's happening with inflation, right? So there's a lot of talk in the news about what's happening in inflation and what will happen with inflation as a result of some of the president's policies in Washington, specifically with tariffs. And so if we look at inflation rates, February's core PCE, which is the sort of preferred measure for the Fed, came in at 2.65%, which was down from 2.86% in January. And then, year over year, it's down from 3.06%. And the core PCE is basically a basket of goods and services, excluding energy costs and food costs. We know that energy costs are coming down pretty quickly right now. You can see that at the pump. And food costs have been pretty sticky. Everybody thinks about egg prices. So there's a lot of worry about what's happening with inflation. And as a result, what will the Fed do?
Yeah.
Now, most market followers think that the market is priced in 3 quarter-point rate cuts in 2025. Depending upon who you talk to, that may be, a little bit too optimistic. But so there is some belief that the Fed will cut. If they don't, that will cause volatility for the markets.
Right.
and then employment data and economic growth concerns. So we're beginning to wonder, what's the economy going to do? So we came into the year, economic data was pretty strong. The likelihood of a recession in 2025 was quite low. But now we're starting to see some leading indicators, the stock market being one, and the other being the yield curve being another, that would indicate that we may be looking at some slowing economic data. So it is interesting that Treasury yields have been dropping, even though we think there may be more inflationary pressure. Is the bond market looking farther out at potentially an economic slowdown? So we have an inverted yield curve again. We didn't for about 6 months, but we do again now. And sometimes that is a harbinger for economic slowdowns.
Yeah. Well, it says something about the market and investor sentiments. Not to jump ahead, which we'll get to that later, but if the bond market is starting to reflect fears about recessions, where we're seeing lower yields, higher bond prices, as opposed to what generally fears about inflation, how that's reflected in the bond market, which might be higher yields, lower bond prices. That does kind of suggest that investors' fear and sentiment is shifting from inflation to recession as a possible future outcome, which you kind of see in the bond market. People tend to turn to the bond market for safety when there's fear about recession. So that may be a sentiment that's kind of shifting right now, which predominantly the story of the bond market since 2022 was largely the fear around inflation and what will happen with interest rates.
Mm-hmm.
That may be shifting.
It is interesting as well to note, Archie, that, and you've noticed this, I know. In fact, I was just reviewing a portfolio with a nervous client this morning, and he said, I'm fairly conservative, as you know, Rob, and I said, yep, I do know that, and I just want to make sure that I'm not overly exposed to whatever is happening or might happen in the markets. And I told him, well, your portfolio is about half stocks, mostly large U.S. companies, and the other half is bonds, and shorter duration bonds. And I said, the stocks are off about 4.5% so far this year, and the bonds are up. So your portfolio is down slightly at I think his portfolio was down about 1.4% year to date. So the moral of the story is that, once again, bonds are doing what we hope they will do, and that is create some uncorrelated return and risk characteristic to the portfolio. So yeah, stocks have come down since in the last few weeks. Bond prices have come up.
Yeah. I mean, bonds did the opposite of what we would want them to do a couple years ago with the last major
true.
Bear market. Stocks were down. Bonds were also down, and you don't normally want to see that. It can happen, and it has before, but in an ideal scenario, bonds are providing a cushion and maybe, pushing your portfolio value up while stocks are pushing it down, and it sort of balances a little bit. It's not a perfect one-to-one.
Yeah.
But
why don't we talked a little bit about some of the anxiety that's coming out of the actions that are happening in Washington. We're in the Washington area. We're expecting to see unemployment numbers tick up on a regional basis. And we have a lot of friends and people we really care about whose jobs are at risk. Some have already lost their jobs. So there's a lot of anxiety around that. Some of that has found its way to the stock market. So the sort of the geopolitical piece of this is absolutely contributing to volatility. But let's talk specifically, Archie, about market sentiment and investor behavior.
yeah, I mean, that is you can't talk about what's going on in the markets and market volatility without talking about sentiments among investors, because that we're all human, and we all have a tendency to feel fear or potentially greed or elation, depending on what's going on in the markets, and then make investment decisions based on that. And we're all doing certain things collectively, and we can kind of sort of move the market based on the fears or greed or elation. And so you can't really look at what happens in the short term and exclude that. We're not perfectly rational actors.
And we tend to move in very large blocks, right? So if I'm feeling anxiety about the markets, feeling some fear, and I'm tempted to make an investment decision based on that, well, there's a really good chance that the person sitting next to me or across from me or down the street is feeling exactly the same thing. And so as a population, we tend to move, like you see a flock of birds flying across the sky, and then there's something they all see and they all turn immediately. It's the same sort of thing. It's the animalistic nature that we all share.
Right.
And it's not a negative thing unless it causes you to make a bad decision.
Right.
Yeah.
Yeah. I mean, being patient and being disciplined is sort of like the antidote to that. And because, when and you read about some of the great investing minds, Ben Graham or Peter Lynch, Warren Buffett, these guys, there's all these interesting sayings that they come out with. And, one of them was like, start investing when there's blood in the streets, or I'm butchering it, but when people are afraid, if you keep your cool, or greedy and excited and wanting to get a piece of the action, if you keep your cool, it's going to be easier to make good investment decisions, even when sort of the crowd is moving the market in a direction that maybe is unwarranted, at least in the short term. And so
they can change direction just as quickly and move the other way. And that's the thing that's unpredictable. Let's transition from the sort of the sentiment to what investors ought to be doing right now.
Yeah.
Right. So we know that there are certain things you can do to reduce the volatility and to manage risk in your portfolio. One of them is to just not take the risk at all, not invest. And most people can't afford not to invest, frankly. That's a luxury. But some people for some people that just can't handle the volatility, maybe they shouldn't be investing. They should do something else with their money.
Right.
So the other thing is to stay diversified. This is what most of us do, is to have a diversified portfolio that gives you exposure to lots of different asset classes and lots of different types of regions where you're investing, and to spread that risk so that when one or two asset classes are performing poorly, maybe another asset class in the portfolio is performing well.
Right.
So it reduces the downside volatility and improves your long-term investment results.
Yeah. And that applies to within your stock portfolio. You can be diversified, like you were saying, different company sizes, different regions of the world. It also applies to going beyond just stocks and into bonds. Or sometimes people will invest in, commodities or real assets, real estate. So these different types of investments have different characteristics and perform differently. And so most often it's a stock and bond mix that people have that provides that low correlation. They're not doing the same thing at the same time most of the time.
Yeah. In addition to that, you got to keep a long-term focus. So, and I have these conversations with people, everybody talks about being long-term. Well, some of what I am is short-term, right? Yeah. Well, the money you need to meet your short-term needs should not be at risk in the market.
Yeah.
Right? You should have that safety fund, that emergency fund, in case you need money when the market happens to be down, you can tap that. Otherwise, you've got to maintain a long-term focus.
Right.
And then periodically, when you have these big changes in the market, it's an excellent opportunity to rebalance the portfolio to get back to your target allocations. That means that you're going to be selling assets that relative to other assets in the portfolio are overpriced, potentially. So they're overweight. Maybe you're overweight stocks. You sell some stocks, buy some bonds. Then the market goes down. For your account, it goes down less because you sold some stocks and bought bonds.
Yeah.
So usually whatever has been performing poorly recently will be the next thing to perform well. It's not always the case. It seems like it. So you can take advantage of that through rebalancing.
There are definitely some things to avoid in markets like this. The big one is panic selling. Selling off your investments when they've lost value, and thinking in terms of how do I provide the short-term relief and protect things. But what you're doing is you're sacrificing your long-term results, because when you sell it at a loss, you have to buy back in at least the same level or less. Otherwise, you're sacrificing the recovery and that future return, which is more than likely around the corner.
Yeah.
6 months, a year away. And you'll be kicking yourself for doing that down the road when you realize how much you sacrificed.
And you're not going to feel comfortable getting back into your investment strategy until all of the fear is gone. And all of the fear is gone once the market has reclaimed its old highs.
Right.
So you will have locked in those losses. That money will go to money heaven, and you will never see it again. So this is the problem with trying to time the market. Please, please, please do not time the market.
There is someone on the other side of that transaction who is
making
very
your money,
willingly accepting the price that you're offering, which is probably less than what it's worth. So just remember that patience and discipline. Be the patient and disciplined investor, and not the panic.
And if you need help, get a coach.
Yeah.
Get a coach. It's not that expensive.
It's a huge part of what we do.
Yeah.
We spend, especially during markets like this, we spend a lot of time helping people make good, clear-headed decisions around this stuff. So I think that's about all we have time for today. This was interesting topic. If you enjoyed it, please remember to leave a comment, like, subscribe, hit the bell for notifications, share it with your family and friends, and we'll hope to see you next time. You've been watching Last Paycheck, weekly wisdom to help you retire and stay that way. If you like this show, be sure to hit like and subscribe. Last Paycheck is available anywhere you get your podcasts.